Thank you, sir. Pretty much last week was going into the ECB with expectations what was going to happen with the euro, and as a result, what would happen with the British pound in anticipation of the Brexit. And then leading into Friday, which was a couple of days ago, was what is going to happen next week, which is, of course, the most expected Federal Reserve meeting of the year. Just taking a quick look at the charts in front of you before we get into the individual events, you can see that by far the dollar has been moving very high, very strongly to the upside, and it closed the week at the 101.61, pretty much maybe 40 pips off the high of the year. I mean, the high of the year is the 102 something. And we just closed, as I said, 40 pips from the high of the year. And the key issue is the trade for all of next week is going to be the anticipation of what would the Federal Reserve Bank is going to do. It is one of the rare events that pretty much everybody in the market is expecting that the Federal Reserve is going to raise 25 basis points. And it has become a situation that this hike is a fait accompli or a done deal. What's being now more important is what would the Fed actually say in their statement about the economic situation and their anticipation of how many hikes they are going to do in the next year, in 2017. So the discussion between the analysts so far is divided either a minimum of 2 hikes after the December hike or 3 hikes, let's say 1 each quarter. So the first quarter of the year, 2017, would be 1 hike. Maybe the second hike would be in the summer so that they can see the repercussions to the economy from the first hike. And the third hike would be pretty much into November or December next year. So what's more important next week, which is again of much more importance than the actual rate hike, is, as I said, the statements of the Fed. And by looking at the chart in front of you, you can see that, again, we are pretty much in a bull market, if you will, and we are, these moves has pretty much been, let's say, discounted. I mean, everybody, or all those analysts, I mean, when you have this unanimous consent, you would assume that all their financial institutions, as well as their followers, have either bought already into the dollar or they hedge against the decline in the other currencies. So this is one of the very rare events when you can say an event is already been discounted in the market. What we have to anticipate next week is the reaction. there are two issues. What if they actually raise a 25 basis point? What is going to happen to the US dollar? That is the first option. What should we expect as a result of raising the interest rate for the dollar next week? And then the second question would be, what happens if the statements they make is not too bullish or not too conservative? To answer those two questions, we need to look at this chart. Now, it's a very important chart, and I'm just putting it clearly for you without lines, so we just analyze it. If you take a look at this chart as is, you can see that we can say that this is a structural failure here, which is the 8713 right there, and it's been, you can see how many times, starting from here, once, twice, 3 times, 4, 5, 6, 7 times it was hit and bounced off it. So it's a formidable structural point. And then we broke above it right here. So we can say technically, or based on our methodology or the way we trade, that we do have an uptrend in the dollar. Again, it's evident. I'm just repeating or going through the analysis step by step. And then we came here and we put a momentum high. Which is 101.65. Okay, so this is our momentum high, and right now, we are at that momentum high. If I add more data to the chart so we can have a better view, you can see that the 101.65 is now technically a new structural point. And even we can say here that this is a trend change and a first push higher. Any move above the 105.65 would actually begin the next wave up in the US dollar. To assess the importance of the 101.65, you can see that here pretty much is the 101.65 again that held, was one of the momentum lows, and then it began so the 101.65 is extremely very important, and moving above the 101.65, the probability of it doing that, based on what I see on this chart, I would say at least 80%, that the next leg up in the US dollar would be beginning upon a trade above the 101.65. I'm saying that as a general direction. I am not saying that this is what's going to happen on Wednesday. But if we are going to play this on quite a long-term trade, we should be looking at being long the dollar in general, either at the end of 2016 and going into 2017 in a general perspective. And there are several reasons for us to support this theory, or there are several fundamental reasons to support this theory. The first, of course, is let's take the easy one, the British pound. The British pound, again, as you can see on the daily chart, or let me put the weekly chart, it's pretty much in a definite bear market. I mean, there is no disagreement about it. And it is, as you can see, we're sitting at the structure point, which is the 125.56. It bounced for a few weeks ago, a couple of times higher, and then it's beginning to roll over and turn around and come down below the 125.56. So the expectation for the pound minimally to go down, I would say maybe to the 118, if not towards the 114 level. So that is one currency, if you will. The next one we're going to look at is the euro. And the euro last week, we had the ECB meeting last week, and Draghi came out and said that basically they are going to continue the asset purchase program until mid-2017, and then they're going to continue after that, but they are going to taper or lessen the amount of asset purchase that they will be buying. Instead of buying 80 billion euros every month, they are going to buy 60 billion. So that is starting from April, and from April to December next year, they're going to be buying 60 billion instead of 80. So this is just a minor amount. They're cutting the tapering a little bit, and this cut in the tapering from 80 billion to 60 billion is what triggered this push higher from the 105.35 to the 108.50, because people now took the tapering as a kind of like raising the interest rate. I mean, so they're going to cut the liquidity or the amount of cash euro infusion, and as a result, the euro bounced from 105 to the 108. Then, of course, by the end of the week, cool heads prevailed, and because everything that Draghi said maintains that the ECB is open-ended, and he was very clear that all the analysts, the staff of the ECB, forecast to the governing council is that they don't really expect inflation to go higher beyond 1.7%. As you know from our many previous discussions, that the mandate of the ECB is to keep or to have a target inflation of 2.00%. So right now, with all the information that we have, or what they have, all the stuff and forecast is way below the 2.0%, and it's actually now it's still, I mean, on their most optimistic is 1.5%. So they are very far, and as a result of that, he is going to, or the ECB is going to continue its easing. So there is a downside risk on the euro associated with this forecast, but the good and positive point that Draghi came out with is that deflation, which is the biggest fear that Europe, the ECB, and had, was that Europe would go into deflation. And as you know, deflation is one of the toughest things, economic situations, to be handled by any one single government, let alone it is a monumental task if you have 27 different governments and you're negotiating how to deal with deflation. So the good statement that Draghi said last week was that pretty much the deflation in Europe has largely disappeared. And this seems to be as a result in the increase in the prices of crude oil. As you can see, this is the chart of crude oil, and crude oil has been moving quite high, and we are pretty close to starting another leg up. So they're looking now that crude oil should be going higher towards maybe, I would say, the 55. As you can see, this low here and this. So it should be going to the 55, if not a little bit higher. So also Draghi said, we have to finish the euro, is that Draghi was very clear in the conference that there is a very good consensus that they will extend these purchases beyond 2018. And he also stated that tapering or cutting off or slowing that the purchase has not been discussed. I mean, it wasn't even a subject on the table. And this means that the ECB is going to continue to have a sustained presence in the market. With that said, again, it would be very expected that the euro decline should continue, and we should be looking for the euro to go lower. Now, take a look at this weekly chart. As of this, we have one structure point here, which is a double structure point or very close, which is the 106.28. That's on the index. And if I bring the data or the chart closer, it's the flip opposite of the dollar. And you can see that this congestion here has been from the beginning of, let's say, March 2015. This is an 18 months congestion. This is 18 months. And as a result, we are now testing. We actually broke below the 106. We actually did break below that structure point. So as you can see, we're here at the 105. So by technically breaking below that structural point, exactly the flip to the US dollar, we can expect the next leg down in the euro to start coming down. And conservatively, we're looking at the 99, which they call it parity, and maybe the 95. So the euro is extremely bearish, the pound is extremely bearish, and of course, if the euro is this situation, that it stands to reason that the Swiss franc, and this is the chart for the Swiss franc, will pretty much follow suit. And this, as you can see the chart, these are the structure points. We broke below it. So again, and this is a good timing. The reason I'm going through all of this now is it's important. I mean, I would have had this discussion or this in the new year kind of planning, but actually it's important to have it now, at least for us as a group, to have a heads up on how to plan our we have the FOMC coming up, so you want to be technically long the US dollar, and you have 2 weeks, 1 week to the FOMC and 1 week after the FOMC to buy in to the dollar positions to create a dollar long-term position. You want a long-term short British pound position. You want a long-term short euro position, and the euro is the best one. If technically we have a bigger move to the downside. The pound, I am not really clear how far down we should be going, but you can see here maybe, I mean, these are just we're looking maybe at another 8% ballpark decline in the British pound. We're looking at about this is about 11%. So the euro should shrink about 11%. The pound should shrink about 8%. Remember, these are all bear markets, so these numbers may be exceeded to the downside. So 10 maybe 12, 8 maybe 11, because fear is associated with bear markets. And we can look at the Swiss. Again, there is nothing but air here, so I guess the Swiss might actually might be the weakest, I guess. This has 12%. They're all in the same ballpark. I'll do the dollar, and then we're going to go to the dollar. I would say should, let's see the other chart. I mean, I would say, I mean, if we take it from this structural point to here, this is about 16%. So if we're just going to say that this wave to match this wave in equality, so this we should have pretty much So the dollar should go up to the 120 level. I mean, these are just, we're not doing any prediction, but we're measuring equal moves in every component of the currencies in the dollar, in the pound. Then we come to the one that is extremely interesting, which is the Japanese yen. We have been shorting the yen for quite some time now. We have been shorting the yen from the 95. And as you all know, since 2013 and 14 together, the yen, we took the yen on the that first decline, and then we took it on this way. So it has been a very rewarding currency for a long time. And it's very important, guys, and all of you have the long-term software. The long-term is where the big money is. And you want to be shorting it. So taking the long-term trade. So by looking at what's happening in the yen, the Japanese numbers have not been very impressive, and the estimate, the BOJ estimate for growth for Japan is now 0.2%. It was expected to be 0.5. They lowered it to 0.2, and they are having a lot of problems for the next year. So we can expect that weakness to continue, because we know that they are fighting deflation, and pretty much they are the only country of the major economies that has been suffering from deflation since the 1995s. I mean, this is over 25 or close to, 20, 22 years trying to fight deflation and have yet to succeed. So we should be looking at the yen pretty much to come down back to here, which again we can say it's about 6%, but if you do it in a monetary evaluation, it might slip back down to these lows, and it will give us, I would say, around 10%. So in general view, we're expecting the dollar to go up about 16%, the yen to come down about 8%, the pound to come down about 8%, the euro to come down, the Swiss franc. So to cut a very long story short, we want to be long the dollar, we want to be short the Japanese yen, we want to be short the euro. These are the primary two. We want to be short the British pound, and we want to be short the Swiss. These are primarily the four major currencies that we want to be short. If we also look at the Canadian, as you can see, the Canadian has actually been moving quite nicely to the upside with the rise of prices of crude oil, and usually the Canadian moves pretty much in tandem with oil and the US. I mean, it kind of follows in a way closely, but it's moving higher. So the Canadian now is one currency to be looking at. We want to be, excuse me one second. Okay, 1 second, please. Somebody's having problems. One second, please. So we know that the Canadian dollar, with the rise in crude oil, and I'm not particularly sure how far crude oil is going to go, even though at the minimum it looks like $55. So we expect at least the Canadian pretty much to reach the 77 area or the 78. Again, moving in tandem. So if the dollar is going to go up about it's very weird. Somebody's unable to log in. That's okay. She's in. All right. So the Canadian now. Reed, I know you couldn't log in, so I'm recording the session. So once we're done, because we're nearly done we have another 10-15 minutes, I will email you the link so you can watch what you missed. Okay? So going back to the Canadian now is beginning to move higher. It is now sitting pretty close to the structure point here, which is the 75.80. And as I said, we are looking for the Canadian to move in tandem with the dollar and to rise towards the 78, which is about, if we say 2.6%, let's give it rounded up to 4, because again, these are structural points, and breaking above specifically the 77.92, this will trigger a lot of stops on the way up. So again, it should be exceeded. We go now to the Australian dollar and the New Zealand. So starting with the Australian. There isn't much direction, if you will, to support the Australian dollar or the New Zealand for the time being, other than the interest rate differential. And now, as we expect, again, the U.S. rate hike next week, and as I mentioned, the most important is what will they say in their statement and in the Q&A session with Yellen. So that is the key. So I really just by looking at this chart, and you ask me and ask yourself what is the high probability direction, I would say neutral to down. I mean, again, it's a bear market. This is a congestion. It has failed to go above the structural point several times. It is not really a high probability to buy, rather it's a high probability to decline. So if I'm going to err on a trade, the way I'm going to do that is, for example, I will be shorting the Aussie against the USD. So I will be taking short the Aussie dollar. I mean, that would be a high probability for me. But at the same time, with the weakness in the euro and the weakness in the yen, I can at the same time, I can do this. I can go long the Aussie and short the Japanese yen. And I can do the same thing with the New Zealand yen. I'm sorry, no, this is a mistake. I can go long the Aussie yen, but I wouldn't take a trade with the Aussie. You don't want to be doing both, but again, as you know, we can be looking at that. We can also take the pound Aussie or short the pound Aussie, and the same thing maybe the pound CAD, because the Canadian is going up, and we can also take the again, these are the ones we are going to be. So we want to short the pound dollar. We want to be, I'm not sure how the euro pound is going to play because both of them are significantly weak. So the interest rate move difference is not going to pay us much, but if somebody wants to play it, he or she can. But we have a lot of very good trades setting up for the following year. The same situation with the New Zealand. Maybe the New Zealand is a little bit better. The economic situation in New Zealand is better. So we just, again, we have to trade the Aussie and the New Zealand with a grain of salt because they are more dependent on what happens with China than what happens with the interest rate differential. The interest rate differential, which is 1% now, has been pretty much discounted over the last couple of years. But now we are having a new administration coming up. The expectation of what the new administration, the states that is going to be doing in the first half of 2017 is pretty much trade. The talk right now is that trade is going to be the first target, if you will, or the first project of the new administration, and it is also the most easier thing to do. I mean, it's easy to slow down imports. It is not so easy to raise exports, but we have the oil situation. I mean, because here in the States, the U.S. is now a producer of oil. If he opens the shale production, what impact that is going to have. If he starts placing some executive orders to cut down on imports or put some short-term tariffs on Chinese imports, what effect this will have on the Chinese economy. What will the Chinese response be? And as you know, China is the biggest debt holder of United States debt. So if it gets angry and it starts selling off the US bonds, that is going to create a crisis. So But at least for the first 6 months, everybody is going to be keeping an eye on what happens with the new administration here in the States with regards to trade. And that, of course, will have a direct and indirect repercussion on the Australian and the New Zealand. So the Aussie and the New Zealand vis-a-vis the dollar is not going to be high on our priority list, but the ones that are high is going to be primarily we want to be long the US dollar because now we're breaking above structure point and the new bull leg should continue. The same thing with the euro. It is now breaking down below. It already broke. I mean, the dollar is above the structure point to the upside. The euro is below the structure point to the downside. So we now have the down leg. The same thing with the British pound. We're looking at easily to the 113. So we have another 8 or 9% decline. And last but not least is the Swiss franc. We're looking at another 11% or a 12% decline. So what we're going to do this week is, and of course, I'm sorry, the Japanese yen also in the same again, we're looking at another it should be testing the 2015 low, and if we are fortunate, it actually might make a new low. It really might make a new low because if you remember when we were talking, I mean, we have been enjoying the yen trade for the last 3 years from 2013. Look at this, it has been magnificent. But I just wanted to show you something. This is the dollar yen. And I don't know if you recall when we were talking back in 2013 and 2014, we were saying that it should be going up to the 125, which was the high of 2015. Now we are back at the 115, and if you look at a weekly chart, testing the 127 or even the 135 is technically not very far out, and that distance is another 15%. So we should be having very interesting trades specifically with the yen. So you want to be going long the dollar yen, short the euro dollar, short the pound dollar, going long the CAD yen. I mean, let me put the charts for you here so we can see. I'm finishing up the numbers and I'm going to send it shortly to you. But you want to be going long the CAD yen, for example. You want to be long the dollar yen. We're now above the 115. We can look at the New Zealand yen. So you got the Aussie yen, the CAD yen, the New Zealand yen, and the dollar yen. You want to be short the euro dollar. As you can see, this is how the radar screen looks at you and guides you through your trades. I mean, technically, we should have been short. If you're using the numbers in the radar screen that I sent you, you'd be short the euro from 108, so you got your 300 pips. You should be shorting the euro Oz, you should be shorting the euro New Zealand. The euro pound really didn't do nothing much. You can see that the Aussie dollar is also weakening. So what we need to be playing is shorting the yen. Last but not least is the Mexican peso. As you all know, the Mexican peso has one of my favorite currencies this year. We have talked about it numerous times. And from last week, we should have shorted it below the 20-point spot 50. Now, in the coming week, right after the FOMC or before it, we have the Mexican Central Bank is going also to decide whether they are going to cut or raise their interest rate. The most expected thing is that Mexico will raise interest rate. And we have crude oil going higher. As you can see, this is crude oil moving. I don't know, hold on, my mistake, hold on a second. Okay, so this is the Mexican peso chart. So they are cutting, they are going to raise the interest rate in Mexico. And as a result, if the interest rate goes up, this is the chart for the dollar versus the MEX. I expect between raising the interest rate in Mexico and oil going up, I would expect the dollar MEX to ease a little bit. So we are going, or we should be taking long-term positions in the dollar MEX. I mean, if you want to be taking below the 20.27, which is a 2 or 3 week low, to come back to test the 1944, this is a good pair to trade because the Canadian is going up, then the Mexican should be going up in the same manner. Okay? With that, so to summarize what we're going to do and the numbers that you can understand, from the numbers, we're pretty much going to short the yen. Before I wrap up, just keep in mind that Wednesday next week is going to be very volatile. And the volatility has nothing to do with raising the interest rate or not. Is that traders are going to be listening, reading first the press release, and then reacting to the press conference. And as a result, we'll get some volatility. Whichever the case, maybe you want to initiate some dollar positions from tonight going into Tuesday. So you want, for example, buy the dollar yen and exit the dollar position by Tuesday or Wednesday morning at the max. You don't want to go into the FOMC with, I personally would not recommend going into the, unless you're a very long-term trader, but if you are going to still initiate the positions this week, I wouldn't recommend going into the FOMC with an open dollar position, simply because Wednesday is going to be very reactionary, up and down. However they interpret whatever the statement is, they're going to react. But going forward, you want to be short so you can take any dollar positions and close them Wednesday morning, US time. And then let Wednesday up and down do whatever it does, and then start initiating the position on Thursday. The best example I can give you is looking at the euro-dollar chart. This is when Draghi spoke. You had this reversal, and then common sense prevailed and the market came back to the proper direction. So this is the same way we should be trading. Let it go on Wednesday and then start reinstating. So we want to be long the dollar going into the whole of next year, buying the dollar, shorting the euro, shorting the British pound, and shorting the yen. Short yen, short pound, short euro, and going long the dollar, going long the Canadian, and going long the MEX. These are the primary ones we're going to do. If you're interested in the Aussie and the New Zealand because of the carry trade, if you're looking for a very long-term position and you're trying to garner or gain the 1% or 1.5%, then you want to pair the Aussie and the New Zealand with the pound and the Swiss. Okay? So this is the wrap-up of today. I am going to finish the radar screen, and I will be sending it to you within the hour. Okay? And again, I will be trading during the FOMC. So if anybody of you is having a position or something during the FOMC, feel free to reach out. Okay? All right. Anybody has any questions? Okay. I will send you the radar screen, as I said, within the hour. So all the best, guys. Have a great week, and see you next week. Thank you, Survey. Take care. Bye.